Today is Friday, October 7th, and this is the ADM Investor Services Weekly Market Review. Today's guests are Alan Bush, Senior Financial Economist here at ADMIS, and Steve Freed, VP of Grain Research. Alan, the U.S. dollar made a 10-week high this week as Federal Reserve officials talked up the economy and increased probability that the Federal Open Market Committee will hike the Fed funds rate at the December policy meeting. What is the outlook for the U.S. dollar now?
First of all, in fact, the dollar did make a new 10-week high in the overnight trade, but some pressure developed more recently, specifically due to the employment numbers that did come in a bit on the weak side. But longer term, it looks like the dollar index will continue to advance, and it still looks like the Fed is still the only major central bank that is in a position to possibly raise interest rates maybe this year or next year. So we have to look for continued gains long term in the dollar index.
Gold had its best gains in almost 3 decades earlier this year. However, pressure developed more recently. Has the gold market topped?
No, it hasn't. In fact, even though we have broken the 1,300 support area, and this is primarily due to prospects of tighter credit from the Fed, some hawkish comments from several Fed officials, gold is still up 18% on the year. So that's still a pretty good performance, even though we have seen a bit of a downdraft over the last 4 or 5 days. What we feel is that inflation is coming back, starting out slow. It will gradually accelerate, and that will cause the gold to recover. And I think next year we can see some new highs for the move, not just in the gold, but also in the silver as well.
30-year Treasury bond futures have declined recently in light of hawkish comments from the Federal Reserve officials. What is the outlook for December 30-year Treasury bond futures?
Well, in fact, just today we saw the bonds hitting a 16-week low. So a very critical support was taken out. In fact, the lows that were made in September 21st were taken out. So we feel that inflation is coming back, which is what we talked about with the gold market, and that will be the main driver that takes the bond market lower. Another negative indication today was the employment numbers, which across the board came in weaker than anticipated, which should be a bullish factor for the bond market, and yet bonds are very much ignoring that bullish news, which is an indication that the main trend is lower. And of course, in keeping with our inflation views, we would look for further pressure in the interest rate futures markets across the board, especially for the 30-year bonds.
Steve, bean prices have backed off from last week's high. Why did prices drop, and will they continue to trend lower, and what should the farmer do?
I think the main thing is that we continue to hear record yields across the Midwest. And so next week when the USDA meets for their October crop report, they could raise the crop, raise the carryout, and that could press prices lower. So this week we suggested farmers increase their cash sales, both for 16 and 17 crop.
Corn and wheat prices continue to be at the lower end of this year's range. Can anything help corn?
Well, not really. I mean, I think first of all, we are starting to hear as the harvest progresses that corn yields are better than initially thought, and that they're getting close to record. So this could reduce the chances of the USDA lowering the corn yield next week.
What about wheat?
Wheat, there's just too much wheat in the world. We did see a little bounce this week on short covering because of some export business that showed up, but yesterday we took all those prices off, and there's just too much wheat around. But I think in general, we have to be a little careful of some of the seasonalities, because as we progress through the corn harvest and get into later in the fall, there's a tendency for prices like corn and wheat to make lows, and the funds are short, so we'll see if they come in and cover those shorts after harvest.
This week, Brazil Economic Group came out with the estimates of higher 2017 corn and bean crop production. What impact will that have on the 2017 grain prices?
Well, it'll be bearish. I mean, it's early to put estimates together. Last year, the second corn crop and the bean crop was reduced because of dry weather. We are watching weather pretty closely, and as we shift to La Nina, sometimes Brazil has drier than normal weather, and Argentina has wetter than normal weather. So it's an early guess, and just a guess, but if they do increase, especially their corn crop, it would be bearish to our prices.
And next week, the USDA will release their monthly summer crop production update. What is the market looking for, and what impact will that have on prices?
The funds have reduced their long position in beans going into the report, thinking that they might raise the crop in the carryout. There's some people who think that we should trade beans below $9 if they raise the crop. For corn, again, we were looking for a lower yield, but if these yields come out bigger as the harvest progresses, that may reduce the chances and kind of keeps corn prices in a trading range. They could raise the Russian wheat crop, and that could put pressure on wheat prices again.
Please remember that the opinions expressed here today are solely the opinions of our guests and are not necessarily the opinions of ADM Investor Services or Archer Daniels Midland Company. If you have any questions or comments or would like to know more about our services, please contact us at www.admis.com.